Well, hello, everyone. Welcome to part two of our webinar on navigating the new investment advisor advertising rule. If you missed part one, which we provided on June 21st, we covered a high-level overview of the new rule during that webinar, which included a lot of detail around the definition of an advertisement and the 7 general prohibitions that the rule includes. We have already emailed out a link to the recording of part one, but if you did not receive that email or you can't find it, you can always go to our website, www.vista360llc.com, and if you click on the upper ribbons on the Viewpoints tab, you'll be able to find the recording there. That's where we post all of our compliance-related communications. My name is Dan Weitzel. I'm a partner and the consulting manager at Vista 360. I'm joined today by two of my fellow partners and senior consultants, Stacy Conroy and Leela Harris. They'll both help present today's information. You can find our bios on our website, again at www.vista360llc.com. So here's an overview of what we'll cover today. First, we will cover testimonials and endorsements, including a discussion of the definition of each, as well as the requirements that advisors must fulfill when using testimonials and endorsements in advertisements. We'll then cover the use of performance in advertising. There are several general requirements, and then there are very specific requirements for 4 specific types of performance: related performance, extracted, hypothetical, and predecessor performance. And then finally, today we'll cover the requirements for the use of third-party ratings in advertisements, as well as some of the new questions that will appear in ADV Part 1 regarding how the advisor's advertising practices. So with that, I'm going to pass it off to Stacy to walk through testimonials and endorsements.
Thanks, Dan. Okay, the definition of testimonials and endorsements. A testimonial is a statement made by a current client or private fund investor about the client or investor's experience with the advisor or its personnel that directly or indirectly solicits or refers someone to become a client or private fund investor. The definition of an endorsement under the rule is a statement made by someone who is not a current client or private fund investor that describes the person's experience with or indicates approval, support, or recommendation of the advisor or its personnel, or directly or indirectly solicits or refers someone to become a client or private fund investor. Some examples of testimonials and endorsements are solicitation agreements, placement agent services, lead generation firms, advisor referral networks, testimonials by clients, and referral programs for employees or clients. The advertising rule considers communication to be an advertisement if either of the 2 prongs below, above are met, or below on the slide are met. Testimonials and endorsements could be included in advertisements even if no compensation. An example of prong 1 would be if the testimonial is included on the advisor's website, social media, or another advisor marketing piece. Prong 2, compensated, including non-cash testimonials and endorsements. Your traditional cash solicitation agreements under the current cash solicitation rules would currently fall under prong 2 of the new rule. Remember, compensated testimonials or endorsements to one person are considered advertisements. Additionally, live or oral testimonials and endorsements that are compensated are considered advertisements. These are the 2 big differences from prong 1. All compensated testimonials are advertisements under prong 2. If the testimonial or endorsement is not compensated, it can be considered an advertisement under prong 1, depending on how it is disseminated. And some examples of non-cash compensation are directing brokerage in exchange for endorsements, utilizing proprietary investment products in exchange for endorsements, or sales rewards. The overview of the requirements. The new rule prohibits an advertisement from including testimonials or endorsements or an advisor from receiving compensation for a testimonial or endorsement unless the following three conditions are met. There's a disclosure requirement, oversight and compliance, and then misconduct disqualification. Testimonials and endorsements are subject to the above requirements if they are incorporated into an advertisement, like prong one, and must be disseminated to one person, more than one person. Oral testimonials or endorsements aren't considered advertisement under prong one if not compensated. And two, they are made in exchange for compensation, such as prong two, can be provided to one or more persons and can be oral, written, or oral. There are certain exceptions from many of the above requirements for certain types of compensation and certain types of promoters. We will summarize these on the next slide. These are the summary of exceptions, and we'll walk through these after. We'll walk through these exceptions after walking through each of the four rule requirements. Requirements disclosures. The disclosures must be clear and prominent disclosures. What does that mean? Disclosures are presented at least prominently as the testimonial or endorsement itself. Examples would be provided within the written materials that includes the testimonial or endorsement. Not clear and prominent disclosures, an example of that would be layered. They could be included in a hyperlink in a separate disclosure document. Exceptions for the disclosure requirement. No disclosures are necessary if the promoter is an affiliate and the affiliation between the advisor and the promoter is readily apparent, such as distributing a business card. If the promoter is a registered broker-dealer, the disclosure requirements do not apply to any communications with retail clients. These communications are subject to Regulation BI. Disclosures must be provided to institutional clients, but only the clear and prominent disclosures are required. In all other situations, the disclosure requirement is applicable. Compliance and oversight requirements. The advisor must enter into a written agreement with the promoter that describes the scope and terms of the compensation and the agreed upon activities. The advisor must have reasonable basis for believing a testimonial or endorsement complies with the rule. Since the rule does not prescribe any required procedures, the advisor must put in place reasonable procedures based on risk associated with the promoter or the testimonial or endorsement. Some examples would be training, pre-approval of travel and expense forms, or language in the written agreement. Some exceptions for written agreement, the written agreement requirement. No written agreement is needed if the testimonial or endorsement is uncompensated or involves only de minimis compensation, which as de minimis is defined as exceeds $1,000 over the last 12 months. No written agreement is needed if the promoter is an affiliate, and exceptions for the requirement to have a reasonable belief of compliance. There's no exceptions for that. Requirements for misconduct disqualification. Both disqualifying SEC action and disqualifying events are described in great detail within the rule, the definition section of the rule. The rule does not expect the advisor to know with 100% certainty as to whether a misconduct disqualification occurred. It does have to exercise reasonable care. If the advisor does not know about an event but exercise reasonable care, it will not be considered a violation of the rule if it compensates a disqualified promoter. Examples of reasonable procedures include, but are not limited to, questionnaires, certifications, agreement provisions, and representations. Exceptions for the misconduct disqualification does not apply if the testimonial or endorsement is uncompensated or involves only de minimis compensation. De minimis compensation, again, as we alluded to in the slide before, is compensation that exceeds $1,000 over the last 12 months. Does not apply if the promoter is a registered broker-dealer and not subject to a statutory disqualification under the Exchange Act 3A39, and does not apply to the promoter if a covered person is not qualified under the bad actors disqualification rule 506D of Reg D. With that, I'll turn it over to Leela to discuss the performance advertising.
Thank you, Stacy. So the first of the general performance requirements outlined in the advertising rule is that if gross performance is included in an advertisement, net performance must also be included with equal prominence. What does equal prominence mean? Equal prominence means on the same page and displayed in a manner that allows gross and net performance to be easily compared. Under the new rule, it would be unacceptable to include gross performance only on a slide and then reference to another slide or another page that includes net performance. Gross and net performance also need to be provided for the same time periods, and they need to be calculated using the same type of return methodology. And this requirement applies to all advertisements. It doesn't matter whether the audience is institutional or retail. The advertising rule also specifically defines gross and net performance and outlines certain requirements and guidelines for the calculation of net performance, which we'll discuss on the next slide. Gross performance is defined as performance results before the deduction of investment advisory fees and expenses. And net performance is defined as performance results after the deduction of investment advisory fees and expenses. The advertising rule requires that certain types of fees be deducted in the calculation of net performance, including investment advisory fees paid to the advisor, advisory fees paid to underlying investment vehicles, payments the client or investor reimburses the advisor for, and custodian fees paid to the advisor, which includes custodian fees where the client reimburses the advisor for those fees that are then paid to a third-party custodian. Additionally, custodian fees paid directly to a third-party custodian may be deducted to calculate net performance, but are not required to be deducted. The advertising rule also allows for model fees to be used to calculate net performance only if using a model fee will result in performance returns that are no higher than if actual fees had been deducted, or when the model fee used represents the highest fee that would be charged to the intended audience. When performance is included in an advertisement, the advertising rule requires advisors to include performance for prescribed periods of 1, 5, and 10 years. The prescribed performance periods are intended to allow the audience to review the history of performance on both a short-term and long-term basis. Prescribed performance periods are required to end on the most recent calendar year end at the latest. And if the strategy hasn't been in existence for all of the prescribed periods, then advisors should use performance since inception instead of the performance period or periods that are not applicable. The requirement to show net performance when gross performance is shown also applies to the prescribed periods, so you want to make sure to do that. And the prescribed time periods are required to be shown in equal prominence to each other. We want to note here that prescribed performance periods are not required to be shown with equal prominence to all other performance information shown in the advertisement. However, keep in mind that the general prohibitions of the rule still apply to all performance information. So information used in advertisements, so advisors need to consider if showing the prescribed time periods on a separate page from other performance information that you want to include in the advertisement is misleading or would otherwise violate any of the general prohibitions of the advertising rule. And then finally, prescribed performance periods are not required for private fund performance. With regard to prescribed performance periods needing to be as of the most recent calendar year end, the SEC has issued an FAQ, which indicates that during the month of January, advisors can include prescribed performance as of the end of the third quarter until performance results for the most recent calendar year end are available. And we also just want to make sure it's very clear that other performance periods can be shown in advertisements. For example, the most recent quarter or month end, only if the prescribed performance periods are also included in the advertisement. The advertising rule prohibits advisors from making any statement that explicitly or implicitly indicates the calculation or presentation of performance has been reviewed or approved by the SEC. We included an example of some language that cannot be used on this slide for your reference. All right, disclosures. The advertising rule does not require any specific performance disclosures. However, when presenting performance in advertisements, it's going to be very important you not only follow the requirements based on the type of performance shown, but that you also include adequate disclosure regarding the performance results to avoid violating any of the general prohibitions of the advertising rule. Examples of elements advisors should cover in their disclosures include, but are not limited to the type of performance shown and what the returns represent. So is it net or gross performance? Which fees and expenses were or were not deducted to arrive at the gross or the net performance? Were there any material conditions, objectives, or strategies used for the performance results shown? Whether and to what extent the performance results reflect the reinvestment of dividends and other earnings, the effect of material market or economic conditions on performance, the possibility of loss, and any material facts relevant to comparisons to an index or other benchmark. Keep in mind that certain types of performance, for example, hypothetical performance and predecessor performance, do have specific disclosure requirements above and beyond the general performance disclosure considerations we've outlined here. And with that, I will pass it along to Dan to discuss related, extracted, hypothetical, and predecessor performance.
All right, thank you. So important to note that the rule lays out these 4 specific types of performance: related, extracted, hypothetical, and predecessor performance, and has some specific requirements for each of those that are unique to the risks that they present. For all other types of performance that don't meet these requirements or these definitions, you pretty much just have to look at the general prohibitions and the general performance requirements, which Leila just went through. So we'll start with related performance. So this is the concept of presenting the performance of a strategy or a composite, or anytime you're presenting performance that either explicitly presents or merges together more than one account. And this rule is really designed so that advisors can't cherry pick low performing portfolios and leave them out of the presentation of the performance of a strategy, for example, in order to boost the perceived performance results that the audience of the advertisement is viewing. So the general requirement is fairly straightforward. Basically, it says related performance cannot be used. So if you're going to use related performance in a piece, you have to, by definition, include all portfolios that meet the definition of a related portfolio, unless you can meet these two specific conditions. And essentially what this is saying is, if you try to remove one of the portfolios that would have been considered a related portfolio, and the results become materially higher than if you were to have included it, then you're required by the rule to include it. So basically you can't remove portfolios and materially boost the performance that you're showing. And the other requirement is that if you are going to attempt to remove a related portfolio from the presentation of performance, it can't alter your ability to present those 1, 5, and 10-year prescribed time periods. So if you have performance going back to 10 years in one portfolio and you remove it, and all of a sudden it doesn't allow you to present that 10-year performance anymore, you have to include it. So then what is the definition of a related portfolio? So it's basically any portfolio that has substantially similar investment policies, objectives, strategies to those services that are being offered within the advertisement. So some things that would not be considered substantially different would be just if you're charging a different fee rate or different expenses to one portfolio versus the rest, that would not be considered substantially different. But if, for example, the client puts significant investment restrictions in place or constraints on the account that force the advisor to manage that account in a materially different way from the rest of the portfolios within that strategy, that could be considered substantially different and make that account not a related portfolio and therefore not required to be included when related performance is shown. So the definition of related performance is just the performance results of one or more related portfolios. So again, if you're going to show a single account, the performance of a single account, that would not be, considered related performance. But once you add in a second account or you merge the performance results of two or more accounts together to show a strategy performance, then that is considered related performance where the rules would apply. The rule allows for two different presentations of related performance. You can either do, aggregating the results together into a composite and showing a number for the strategy, for example. The second option is displaying them on a portfolio by portfolio basis. So this might be more effective for smaller advisors that have a small number of accounts or a small number of related portfolios, and you can highlight the performance of one portfolio, such as like a flagship fund or something, against the performance of other portfolios that are related and are in a similar strategy to highlight differences or something like that. So there are two options here for how you present them, but the key thing is to comply with the rule, you have to include them all unless you can meet that specific instance where excluding one does not result in materially higher performance results. So some additional considerations, because you are required to not materially boost your performance by excluding a related portfolio, the advisor is going to need to calculate the performance with and without that related portfolio if the advisor wants to go down the road of excluding a portfolio. So you should retain evidence that you did the calculations with and without that portfolio to show that it was not the performance was not materially increased before you would feel comfortable utilizing an advertisement that excludes a related portfolio from the performance results. And then generally a representative account. So if you were going to, for example, present a flagship mutual fund as representative of the strategy, of the performance results of an entire strategy, you're generally not permitted under the rule to do that. The only way that you could do that is if you were to be able to prove that removing all other accounts from that strategy, all other related accounts from that strategy, wouldn't result in material increase in the performance over all of the prescribed time periods. So the likelihood of that happening is probably pretty small. So generally, representative accounts are not going to be permitted. So that's related performance. The next idea we'll walk through is extracted performance. This one's a little bit more simple. The idea here is extracted performance is just the performance results of a subset of investments extracted from one single portfolio. And that's important. So an example would be is if you have a balanced strategy for a client that has equity and fixed income securities within it, and you want to offer an additional service, which is an account that would focus on equities only. You could do that through an advertisement where you extract the equity only portion of that single portfolio that the client has with you already, and show how the equities performed over over periods of time. You'd be able to do that under the extracted performance requirements as long as you meet the condition that you provide or offer to provide promptly the performance results of the entire portfolio, as well as the extracted performance that you're providing in the advertisement. One key thing to point out here is, again, extracted is only when you're pulling the performance results of a subset of a single portfolio. If you were to take my same example of a balanced, and you had 10 accounts in this balance that are in this balance strategy, and you wanted to create a composite of the equity portions pulled from all 10 of those accounts and aggregate them together into a composite, that is no longer considered extracted because the results you're showing are not from a single portfolio, they're from more than one portfolio. So the rule release makes it very clear that that scenario is considered hypothetical performance and not extracted performance. So you can do that, you would just have to comply with the requirements of the hypothetical performance within the rule, which are much more, a little bit more of a challenge to do. So some disclosures that you may want to consider when presenting extracted performance, because again, performance is subject to the general prohibitions of the advertising rule as well. So disclosures are a key way that you make sure that you're not violating any of those general prohibitions. So you could consider a statement to indicate that the performance is a subset of a portfolio. Probably very important information to include that. And then in order for the performance to be clear on what exactly the audience is looking at, you'd want to include a disclosure around how the cash was handled. So whether, how it was allocated, what the effects of a cash allocation to the various extracts that you're showing, or the impact if you chose not to allocate cash. Okay, so the next concept is hypothetical performance. So as a general definition, this includes any performance results that are included in an advertisement that were not actually achieved by any portfolio managed by the advisor. So some examples, model performance. So this would be a couple of things. If you maintain, the advisor maintains a model that sits alongside client accounts that are actually invested in the strategy, but the model isn't actually invested in an account. It has, slight adjustments to weightings or allocations, so therefore, not representative of an actual account. That model itself, if you were to present the performance of that model, that would be considered hypothetical. Any, computer-generated models or investment models that are purchased from a third-party model provider, or even investment models that the advisor creates and provides to a third-party advisor for use with their clients. You can't present the results of any of those without it being considered hypothetical and meeting the definition or the requirements of hypothetical performance. Also, back-tested performance is considered hypothetical. So that would be, applying a strategy to prior periods when there were no investments actually made in the strategy at the time. Targeted or projected performance is considered hypothetical. So that would be, stating that a strategy is targeting a specific percentage return. That's considered hypothetical. And finally, like we talked about on the last slide, if you were going to create a composite of extracts from various accounts, merge them together and present that performance, that's considered hypothetical. So what is not considered hypothetical then? If you're going to make projections on market performance or economic conditions, so if it doesn't actually have to do with a service or strategy that you're offering, it would not be considered hypothetical performance because it wouldn't be considered performance advertising under the rule. So you're allowed to make projections that relate specifically to the general markets or economy. Also, if you're going to provide interactive data tools that the client or investor could potentially use to figure out, how they want to invest and what various outcomes might be if they invest in various allocations, you're allowed to provide those tools to be used by the client or investor as long as you meet some certain conditions in the rule. But the key is that the client or investor has to use that tool, not the employee. If the employee uses a tool like that and then provides the results to the client or investor, that would be considered hypothetical because it's being presented as if, as if it's performance rather than being something that is derived from a tool that the client or investor themselves is able to use. And then finally, proprietary accounts or seed money is not considered hypothetical as long as it's representative of, as long as it's substantial enough that it's representative of the actual strategy that you're advertising. Okay, so the requirements for hypothetical performance. All of these conditions must be met. The advisor has to adopt policies and procedures to ensure that the hypothetical performance that's included in the advertisement is relevant to the likely financial situation and investment objectives of the intended audience. So this is going to require the advisor to a couple things: have good policies and procedures that lay out the various types of hypothetical performance that may be used in pieces, marketing pieces, and what the intended audience is, because you want to make sure that you're not disseminating advertisements to audiences that the performance is either too complicated for or just not appropriate for. So policies and procedures sort of need to lay that out, and you might have different audiences for different types of hypothetical performance depending on the risk, but then also have good controls internally to make sure that you're sort of locking down those advertising pieces that have hypothetical performance included in them, and make it very clear what the audience is so that they're not accidentally disseminated to someone that they shouldn't be. Another requirement is the advertisement has to include sufficient information that enables the audience to understand the criteria used and the assumptions made in arriving at that hypothetical performance, and include sufficient information that the audience can understand the risks and limitations of using that hypothetical performance in their decision-making process. And again, that information is going to vary based on the type of hypothetical performance that you're using and what your intended audience is, how sophisticated they are, what sort of tools they have as well. So it's not going to really be one size fits all disclosure. Another key point here is that hypothetical performance does not need to comply with the prescribed time periods, and it does not need to comply with the related performance requirements or the extracted performance requirements. Okay, one of the most important things about hypothetical performance is the audience that it can be used with. You can only use it if it's relevant, like we said before, if it's relevant to the likely financial situation and investment objectives of that audience, and if the audience has access to resources needed to independently analyze the performance and has the financial expertise to understand the risks and limitations. So essentially, it has to be appropriate for the financial sophistication of that audience, and you shouldn't be using hypothetical performance with people who aren't able to understand it, essentially. What this means, the big takeaway is that anything that includes hypothetical performance is not going to be appropriate for general circulation or mass audiences. So you should not be posting hypothetical performance information or pitch books or any other sort of your common advertising pieces. You should not be posting those on your website, on social media, or any other place where just the general public can get to it, because your intended audience has to be defined, and you can't, you have to make sure you're isolating the recipient of that information to that defined audience. And it also means that because, the rule cares about this financial sophistication and the access to tools and analysis around that hypothetical performance, that it's much less likely to be appropriate for use with retail audiences. Okay, the last specific type of performance that we'll cover is predecessor performance. So this is generally, performance results that are achieved by investments that were not advised by the investment advisor at all times during the periods that are presented. So if the advisor had personnel that were working for a different advisor and an entire team came over to the advisor and brought their performance results with them, you can do that as long as you meet the requirements of predecessor performance. And it would also cover if the advisor was, spun out from a different advisor, and the team, achieved results before that advisor was spun out. You could present them in the new advisor's marketing materials as long as you meet the requirements. The rule does make it clear that a rebranding or, like a simple reorganization for, like a corporation to an LLC or something like that, generally does not result in a change that's substantial enough to have that prior performance be considered predecessor performance. And then there's 4 requirements here for use of predecessor performance. It could only be utilized if the individuals that were primarily responsible for achieving that performance are managing accounts in the relevant strategy at the new advisor. So you have to make sure that the decision makers, a substantial portion of the decision makers, come over to the new advisor and continue to manage that strategy before you can use that predecessor performance. And you have to make sure that the accounts that are managed at the predecessor firm and your current advisor firm are substantially similar, such that the performance that you're presenting is going to be both relevant and essentially not misleading. You have to also think about like the related performance rules here. So if you're going to include predecessor performance, you have to make sure that all accounts that were substantially similar to the predecessor, that were managed at the predecessor firm, are included in essentially the composite that you're making. And then finally, the advertisement has to clearly and prominently include all relevant disclosures, including explicitly that the results were derived when those accounts were managed by another advisor. And with that, I will turn it back over to Leela to discuss third-party ratings.
Thank you, Dan. Third-party ratings are defined as ratings or rankings of the advisor that are provided by a person or entity that is not related to the advisor, who provides ratings or rankings in the ordinary course of their business. Some common examples include certain investment-related publications like Barron's or Pensions and Investments. So when utilizing a third-party rating or ranking in an advertisement, advisors need to meet 2 requirements. The first is due diligence. The advisor needs to have a reasonable basis for believing any survey or questionnaire used for the rating or ranking allowed for participants to provide both positive and negative feedback and was not designed to produce a predetermined result. And the second requirement is to have clear and prominent disclosures. So the advisor needs to include disclosures, including the date the rating was given, the period it covers, what entity performed the rating, and whether the advisor paid anything to that entity in order to participate or use the third-party rating in an advertisement. And now I will pass it along to Stacy to talk about the Form ADV Part 1 amendments required by the new rule.
Thanks, Leila. The SEC has already included in item 5L of ADV Part 1, the new marketing activity questions listed on the slide above. All questions are yes or no questions, and you are not required to provide any additional information. It's recommended that you leave these questions blank until your first annual update after November 4th, 2022, which is the date of the rule takes effect, which for most of you will not be until your annual amendment of March of 2023. And with that, I'll turn it back to Dan.
Okay, thank you. So that's all we have for you for the recorded portion of today's presentation. Please reach out if you have any questions. You can reach out directly to the consultants on your Vista 360 team, or if you don't have a good contact, you can go to our website and the contact us form, fill that out, or email info@vista360llc.com, and we'll get in touch with you. And finally, if you're participating in our live webinar today, please stick around after this, and we will go through a short Q&A.